Welcome back to Everything Money. It's Seth, your handsome host. I'm here with Paul and Mo. Today we're talking about Google. Paul, it's Paul, right?
Yes.
This company is unstoppable. A lot of people say never bet against these types of companies. The simplicity, the simplicity of Google. There was Ask Jeeves, there was Yahoo, but Google just came out, Mo, with this website with a single bar that you just type stuff in, and it's completely taken over.
I remember
Go on.
where I was the first time I heard about Google.
Tell me.
I was in the University of Michigan Computer Lab.
Boring. I'm
it's
kidding.
called the Fishbowl.
Okay.
And a friend of mine named Chris, I was sitting there and I was using Yahoo. He's like, dude, you don't use Google? I'm like, what's Google? He's like, oh, it's the best search engine. This was 2002. And I was like, oh, and I never stopped using it from there.
I mean, they take over everything. They have the email. I use all the Google Docs.
Gmail is the worst. It's the worst email.
I love Gmail. So let's get after what we're going to do is look at the stock price and see, is it justified? Spoiler alert, it's very high at the moment. And so we want to see, where can we possibly buy Google, this amazing, unstoppable company? Probably not at all-time highs, because we don't buy high and then sell low. We do the opposite. We want to buy low. Go ahead, Paul.
Well, remember, Google has a lot of growth, and that's why we have the stock analyzer tool now versus our last time we did the Google video.
Oh, okay.
So we can sit there and make our assumptions based on growth to see what's what's worth it. Okay.
So by the end of the video, we're going to look at the valuation of Google, look what we should be paying for the stock, and Mo will go over to Mo to look at if they're trading Google, and we'll hit all this right now. Paul, let's talk about Google. Go ahead.
Okay. Microsoft, Intel, and Cisco in 2000 were unstoppable as well. Go look at their charts since 2000. There'll be a time. $1.7 trillion company, 33 PE, so that's an X, 26% profit margin, that's a check, with 55% margin overall.
I just have to stop you.
What are you giggling about?
I just watched a video from Stock Mo, and he said that NEO in 10 years will have the same market cap. So just I'm not
1.7 trillion?
I'm not kidding. Absolutely. So
by the way, he also thinks Tesla will be a huge, so it's kind of like he's going to have it too. Anyways.
This is why I just burst into laughter,
Yeah.
because this is the biggest and best amazing company in the history of the universe. And it's go ahead, Paul. I can't even talk anymore. Go ahead.
Return on assets, very high. Return on invested capital, solid, double digits. This is good.
What's his PE right now?
33.
Well, that's not terrible.
That's not that bad.
Compared to
The fact that we're saying 33 isn't that bad. It's just funny to me.
I'm comparing it relative to the market.
Yeah, well, yeah.
If you're keeping track at home, we want a PE a little less than 20.
Yeah.
And so 32 is not absurd.
We kind of start with 20, kind of saying, listen, if there's growth in there with potential, we're willing to pay it.
Okay, keep
Revenue,
going.
look at this revenue growth stuff.
Oh boy.
96 billion to 195 billion. That's a check. That's doubling.
Okay.
That's doubling. And their profit, I hope it more than doubles. It does. 20 billion to 51 billion. Check mark there. Shares outstanding.
This is pillar number 5, folks.
It's actually down 691 to 673. Check mark there.
Check, please.
They'd be buying back their shares.
Check,
Yeah.
please.
How about
The
current
stock is
assets
banging.
over current liabilities? Pillar number 6.
They have $172 billion essentially in cash and $55 billion in liabilities and total debt of $97 billion. So guys, this is the check of all checks. They have enough cash on hand to pay off all of their liabilities. That is like you at home having your checking account be able to pay off your mortgage in full, your car in full, your student loans, credit cards, every debt you have in the world paid off with a stroke of a pen just from your cash in your bank account.
Should we adjust our market cap because we have cash in the
It's
bank?
just such a really high market cap. It's not
Yeah.
going to affect it much, but technically you should. It's going to affect it by $100 million, not even $80 billion. I mean, so is it really worth it on 1.7? I mean, it's still 5% discount, but we're not really. Yippee!
If you're
kind
at
of thing.
home asking yourself, how do I get this amazing software? You can go pay a lot of money from it from YCharts, Yahoo Finance, or by becoming a patron. Click the link below. You can become a patron of ours, and you get this software, the stock analyzer tool, all the tools we're going to give you. It's astounding, and Paul's going to elaborate on it because he loves it so much, and this is your baby.
So we made this when I was doing all the analysis on these companies last year, and everybody said, where do you get the software? You get the software. And finally I said, you know what? I'll just make the software. Because I realized that it's here for teaching people. We have an app that's coming out very soon. You'll be able to do all these things on your phone, look at company financials, get the news. This will be your one-stop shop for finance in the future, in the near future. And guess what? Whatever price you pay today is locked in forever.
Yep.
You get the 80 cents a day. We have people who paid as little as
$8.
$8 a month for the software because they got in really early.
Last year.
And this is going to $50 a month. So $24 versus $50 a month. You decide. I'm a pretty smart guy. I think 24 is better than 50 when I'm paying things out. So
Check,
you let me know.
please.
Well, what pillar are we on? Pillar number 7, the free cash flow growth for Google. What is this?
It is. We have free cash flow of 27 to 50. That's a check mark. And again, guys, part of the software, I input this line here to give you the free cash flow. That way you don't have to do any work whatsoever. Uncle Paul takes care of you. The average is 31. 31 times 20 is $620 billion.
Okay, now, so we take our free cash flow, folks, then we multiply it times a number to get our desired market cap.
But this is a starting point. So I came up with 620 billion. Does that mean that's the right number?
Oh boy.
Not necessarily. What that means is it's a starting point. Now, the market cap's 1.7 trillion, so it's triple.
Oh boy.
But that's why we have the stock analyzer tool now. We're going to input based on growth levels to see how much you pay, because the faster the growing company, the more you should pay for it. The slower the company, the less you should pay for it. Okay? Very simple. Now, if you look at this 8 pillars, I give it to you right here. Right here, guys, all checks except for 2. Which 2? Valuation. Free cash flow and PE, right?
This means you love the company, not so much in love with the current stock price.
As of right this very second, I'm not. But once we're done with Mo and we go to our stock analyzer tool and input our assumptions, it'll tell me how much I'm willing to pay to get certain returns.
If you're interested in trading in a sort of more fast-paced, quicker style of moving money around, you can trade with Mo. He has set rules. If you join the Patreon, the Bid and Ask Nation, you can follow his rules he's developed for the past 2 decades and make some of that cheddar. And we're looking at Google right now, Mo, and we talked about this. We fired it up before the video, and I know where you're headed with this. Tell us about what's trading with Alphabet here.
I mean, today you're making all-time highs again. Very, very small, but you're making all-time highs. And look, if you go back, man, let's go back. I think we might have to go back a year. And look where they last came through the sweet spot, with the exception of this was that little hiccup back in January that was happening because of everybody who was getting scared. But then it's kind of just gone sideways for a long time. So this is for sure a power stock. Remember, guys, what a power stock is a company that's making over all 4 of its major moving averages, making new all-time highs. And that's exactly what Google's doing. So if you're in this thing, great job. Just great job. Just keep following it. And as it keeps making all-time highs, just stick with it. This is something you don't see too much in this market, that's for sure.
Now,
but
as we enter this overbought region, Mo, we're not getting into this at the moment, are we?
I'm not, just because this has been an incredible run. Can it just keep running? Sure. But to me, I'd rather wait, find another stock, and look at Google from a value perspective. That's my personal opinion.
Paul, this is our new stock analyzer tool. We were supposed to have this out end of July. We released this last week as a gift to our patrons. As always, you deliver early. Happy birthday yesterday, by the way.
Oh, thank you.
Friend. You feel older now? You look older, a day older.
I do.
Show him the stock analyzer tool, and this is how...
Well, I'm a stock analyzer tool.
That's true. What we're going to do is this helps us...
We got Nate the intern to go,
This helps us take the analysis we just did and then come up with some price, which is always the hardest thing for you folks at home. I think it was for me. Is like, now what? I kind of like the company. What should I pay for this? I'm guessing it's not $20 zillion, which it is right now.
Correct. So I do a 7-year analysis whenever I do a stock. When you input the company, it then gives you its 1, 5, and 10-year annualized averages or annualized change. And then your job as an investor is to be conservative, and we offer you 3 different levels: low, middle, high. This should be your most conservative. This should be your most aggressive. There are 2 levels here: share change and desired annual return, where as you're being conservative, the numbers should be higher. So share change, no share change versus negative 1%. The number's going lower over here. It starts high, goes low.
Assuming they're buying back, yes.
Correct. Return, same thing. You want a high return to be conservative. You want a low return to be more aggressive.
Got it.
Okay? So I went and looked at these averages, and I input, this is a big company. I don't think they're going to have the growth they had over the last 10 years. So actually probably should put in lower than 12%, to be honest with you. We should probably put in 10% here, because growing when you're a big company is very, very difficult. And as you get larger and larger, even at 10% growth, I mean, let's look at that right now. Their revenue last year was $195 billion. 10% growth over the next 10 years would take them to $380 billion. Okay, it's a lot, right? But the world's become but does that seem unreasonable? Not necessarily. Is that really the revenue growth? I don't know. These are where the assumptions come into play. These are all my assumptions. I don't necessarily need to go through all of them right here, but I went and looked at the history. I went conservative, aggressive, etc. I hit the analyze button, guys. The company's currently at $2,500 a share. And right now, on the high side, if all the high assumptions play out, you're going to get about a 10% return paying essentially what it's worth today. So basically, this is telling me this company is probably a little overpriced. On the low side, and we always said Google is about $1,000 company. We've been saying that since the last video. So this is actually playing out to be true here. We, as value investors, should pay about $1,000, but overall, it's probably a $1,500, $1,700 company overall, right? And this is what it's telling us. The stock analyzer tool is kind of giving us a gauge for things. Does it mean it's right? I don't know. Let's go change some assumptions here and see.
Paul, you always said this show would get pretty dangerous if I knew what I was talking about. But the second you said about 300-something billion in revenue, I thought, I wonder what Apple is. And sure enough,
170.
325 operating revenue. 325 in Apple last year. I'm just thinking, can't Google, besides the tangible items that Apple offers? I do think
Google, because remember, Google isn't selling hardware.
Right.
Most of their revenue is coming from search. So search it's easier to magnify that versus like hardware development.
They have hardware. It's just not the bulk of
That's not the bulk of
exactly.
They have, I bet you 98, probably 95% of their revenue comes from software and from search and all that stuff.
Yeah.
They're an advertising business, right?
Yep. Yeah. Keep going.
So let's change the assumption a little bit. Let's go revenue growth. Start at 12.5%. Go 15 and 17.5. It still shows it's expensive. Right? So I look at this going, okay, basically this is telling me Google's pretty expensive right now. That's what it's telling me overall, that we need to sit there and be more cautious on Google. Am I buying Google sub 1,500? Yeah, probably. I'm looking at it more and saying, hey, I think I can get this return. I like this a lot.
This is last fall. Go ahead, Mo. I was going to say.
I mean, if you look back to when COVID was happening in March of 2020, it was $1,000 a share.
So, 1,000?
Yeah, the comments
it got a low of $1,008.
We see the comments below, Mo. You guys are freaking nuts and trying to buy Google below that. And Paul, I keep telling you I'm in love with this book that really Richer, Wiser, Happier. That it interviews all the top investors of this last century, and they all. Some of their metrics, Mo, is like, okay, great company. Is it cheap? I'm not buying it unless it's cheap.
Right.
And so as a value investor out there, you need to start thinking, not what is the upside to Google? How big can it go? What is the downside? And I'm telling you, with this price, it could easily get back to just last September, $1,400. And so is it cheap right now? Absolutely not.
Yeah, and I think a lot of people are going to say, because I just said March and the catalyst was COVID. And you're going to be like, well, you had to have a COVID extreme event for it to get to that price. No, that was just the catalyst that made it change. There's always going to, look back at history. Doesn't matter what the catalyst this is.
Let me show you this.
Go ahead.
Look at this stock. Selling as low as...
What is this?
$6, and it's at 42 over here. And if I said to you right now, this stock is about a $10 stock, what would you tell me?
No chance.
Over a 4-year period, it went from 6 to 42. Guess what stock this is? Intel. Guess when this was? 1999.
Oh.
Now let's go look at it. 2009. Guys, this is what I'm saying here. It only went to here. It would end up going up all the way up to here. And you've been like, look how stupid you are, Paul. Look how stupid you are, Paul. You told me to buy it at $10 here. Look how stupid you are.
And this is Intel. This is not some schmuck company. This is Intel.
And this was in 2009. You could have bought it as low as $10 a share. This is what I'm talking about when we talk about people saying, I remember when there was once a comment on our last Google, you guys will never ever see Google sub 1,000. I'm like, okay, maybe we won't. And if we don't buy Google.
That's true.
That's the point. There's 10,000 stocks out there. Your goal is to find 20 or 30 that make sense, that buy at the price that you want.
I also don't get the comment, you won't see it sub 1,000. It was literally just sub 1,000. I mean, it was 1,000.
Remember, we always forget.
What are we doing here?
Financial memory is 4 or 5 years.
Yeah.
We haven't seen a bad market. I mean, yeah, we saw it last year for 1 month.
We saw a bad month.
Yeah, so either way, guys, your job will be to find great companies you can buy at the right prices. Google is a phenomenal company. I think has a lot of potential, but I'm personally buying it under 1,500, which is still higher than I said before. I'm looking at it more under 1,500. And I'm hoping that at some point in the future, which I think will happen, people will view Google as a dead company that still has growing revenue and profit, and I will buy it just like Microsoft in 2012.
That's a take on Google. We love our patrons out there, you know, and our subscriber count keeps exploding every day, Paul. It's incredible. And we appreciate the support out there all over the world. We hope you enjoy our videos, and we certainly enjoy you guys watching them. So that's our take on Google. Follow along. We'll keep doing this. Love you guys. Thanks so much. Oh, and follow that thumbs up on the way out. You know that name. That's what I'm talking about.